We are witnessing history right now in the world of finance. The U.S. Federal Reserve has just increased interest rates by the largest amount in 28 years. And they've done this in response to the inflation crisis, with U.S. inflation recently clocking a fresh 40-year high, as prices have risen 8.6% since May 2021. This had led to fears and speculation around what the Federal Reserve response will be, in particular whether the Fed would increase interest rates by 0.75%, something they hadn't done since 1994. Lo and behold, the Fed has made the decision to increase interest rates by 0.75% at their most recent meeting. But what does this decision mean for the global markets, the economy, and your pocket? As of late, global stock markets and crypto markets have been in freefall. The S&P 500 has now officially entered a bear market, joining the NASDAQ, which entered its bear market in March this year. There's lots of fearful emotions in the stock market at the moment, with investors expecting lots of volatility in the next 30 days. There's concern that the interest rate hikes will negatively impact stock prices, and rightfully so. Meanwhile, crypto markets are collapsing, with the total value of the crypto market falling below $1 trillion for the first time since January 2021. And just for context, 7 months ago, the market was worth more than 3 times that amount. Investors are becoming increasingly anxious almost everywhere. The price of credit default swaps, which are effectively insurance products for bonds, are increasing, and this is especially true for lower quality bonds. This means there's more fear around lower quality companies defaulting on their obligations to investors because of the worsening economic conditions. But there's also fears around government obligations, with the likes of Italy's bond yields increasing to levels not seen since 2014 as investors sell out of their positions. The situation is so bad that the European Central Bank held an emergency meeting on the matter and have decided to implement a new strategy for dealing with the crisis. Anyway, clearly there's a lot of chaos going on in the world of finance, so let's break some of it down. So starting with the Fed's decision to increase interest rates by 75 basis points, this is something that we've been anticipating since the inflation figures for May were released. May's inflation data showed that prices are still accelerating, and as we've discussed many times on the channel, that's a direct result of the supply chain crisis, the conflict in Ukraine, and persistent pent-up demand by consumers for goods. What the Federal Reserve is doing right now is increasing interest rates in order to slow consumer demand, which is funny in a way considering they fueled demand so much during the pandemic through stimulus packages and expansion of their balance sheet to record levels. The basic premise is that the Fed increases interest rates, it becomes more expensive to borrow money, and therefore the amount of money borrowed is limited, which in turn reduces demand. You see, their agenda is controlling prices in the economy and getting inflation down to a long-term average of 2%. And that's the same for both the Fed and the European Central Bank. The problem is that inflation is much higher than 2% and hasn't shown any signs of slowing down, despite the Fed increasing interest rates by 0.75% previously and by another 0.75% now in June. That figure is really significant because it shows that the Fed is taking this inflation crisis seriously and is committed to fixing it. But before we talk any more about the Fed and interest rates, I want to cover what the state of the markets are like at the moment. The S&P 500 has officially entered a bear market, but what does that actually mean? According to S&P Global, a bear market is where the S&P 500 index is priced approximately 20% lower than its previous high. As we can see, the S&P 500's most recent high was in January this year, and since then it has fallen in value by more than 20%, therefore indicating a bear market. The NASDAQ, which is a stock market index primarily associated with technology stocks, is also in a bear market, being down over 30% since its last high. Unfortunately, it's not a case of exiting the bear market as soon as that figure changes to 19.99%. Instead, what's required is for prices to reach their low point and then recover by 20%. For example, the 2020 bear market, which was the shortest bear market in history, started off with prices falling by over 30%. It then ended less than 3 weeks later when prices had recovered by 20% from its low point. But not all bear markets start and end within a 3-week window, which is why investors are fearful. Since the 1920s, the average bear market has resulted in a price decline of 38% and has lasted for over 19 months. But equally, not all bear markets start for the same reasons, and therefore there needs to be caution when trying to extrapolate averages onto to our current situation. If we were to ignore the 2020 bear market, the last time the S&P 500 was in a lengthy bear market was in 2007 with the onset of the Great Recession, and that lasted for a total of 17 months. So it's not yet clear how long the stock market will be in a bear market, but should you be investing? The short answer is always going to be yes. If you have a 20, 30 or 40 year investment horizon and you have a diversified investment portfolio, or you're investing into an inherently diversified investment product like an index fund, then I see no reason why you should stop dollar cost averaging into the market. Now, obviously that's provided you're doing okay with respect to how much cash you have available for investment purposes and things like that, but generally speaking, for long-term investors, this is nothing but a great buying opportunity where everything is on sale. But there are of course risks facing the stock market in the short term, and BlackRock have pointed out 3 notable risks to consider. The first is that corporate profits will likely continue to suffer, primarily because of rising energy costs and increasing wages. Energy prices saw the biggest year-over-year increase in May. This obviously has an impact on corporate earnings, which in turn hurts stock prices. We also know that wages in the Eurozone, for example, are set to increase by the biggest percentage in a decade, as employers try to remain competitive by offering salaries which combat the rising cost of living. This too takes its toll. But it's not just European companies who are increasing wages. US wages are also on the rise in what is the tightest labor market in recorded history. If these rising costs aren't passed on to customers, then companies will fall short of their earnings forecasts, therefore hurting earnings per share for shareholders and resulting in stock price declines. So in the short term, investors risk falling foul of poor corporate results. The second risk here is valuations. The S&P 500 currently has a price to earnings ratio of about 29, which is 47% higher than the market average. That would lead us to believe that based on historical averages, the market is currently overvalued, especially when we consider the points we just discussed around future corporate earnings. In fact, a recent survey carried out on 800 fund managers indicated that 72% of them believe that corporate profits will continue to worsen. But we also have to factor in the impact of rising interest rates. You see, the price of every stock on the stock market is calculated as the market's expectations for future company cash flows discounted back to the present day. The present day value of those future cash flows is calculated using what's known as a discount rate, and the discount rate is invariably impacted by changes in interest rates. To make a long story short, higher interest rates causes the present day value of future company cash flows to fall, which in turn leads to a fall in stock prices. In other words, the higher interest rates go, the further stock prices will fall. This is especially true for growth stocks. Growth stocks are companies who are expected to grow at a faster rate than the market as a whole, and a key characteristic of these companies is that investors are expecting the majority of their cash flows and earnings to come in the future. In other words, they might not be profitable today, but the market expects them to be at some point. Without overcomplicating things, the price of growth stocks are very susceptible to changes in interest rates, and that all has to do with the relationship between discount rates and company cash flows which are far out into the future. It's for that reason that the NASDAQ likely has much more pain ahead, being an index composed of many growth stocks. So that's definitely something to consider as an investor. But perhaps the biggest risk facing the markets in the short term is the Federal Reserve. The fear is that the Fed will continue to increase rates until they're satisfied that inflation is on the way down. Fed Chairman Jerome Powell has noted that the Fed is determined to keep raising interest rates until there is clear evidence inflation is steadily falling. The problem is that rising rates have consequences, the most obvious of which is that it becomes increasingly more expensive to borrow money. Every borrower, be it an individual or a company who has a loan with a variable interest rate component, is going to feel the effects of rising rates because the cost of the loan, the interest, becomes more expensive. That's a very intentional act by the Fed. They want to limit the amount of money circulating in the economy in order to reduce the amount of demand for goods and services, therefore taking some of the pressure off of prices. The problem is that A, companies will borrow less, meaning they'll have less of an ability to expand their operations, and B, consumers will buy less, meaning the total output of companies will reduce. All of this results in a heightened risk of recession. 4 out of 5 of the last recessions have been preceded by a period of time where the Fed are actively increasing interest rates. The higher interest rates go, the more the economy is slowed, and the greater the risk of recession becomes. Now, it goes without saying that recessions are bad news not only for the stock market, but also for the economy. with unemployment having a tendency to spike during recessionary periods. But worse yet, there's a risk that the Fed will cause a recession without even getting inflation down to its desired level. That's what's known as stagflation, and it's described as being the economic nightmare of policymakers. Ultimately, the bullish case for stocks will be the Fed turning around and saying, we can't increase rates anymore, otherwise we're going to tank the economy. So we're going to just live with inflation being higher than our target rate of 2%. Whether or not that would ever happen is anyone's guess. But we do know that the Fed sees rates topping 3% this year, meaning we've more rate increases in store for the coming months, which we expected. And what's most interesting is how the members of the Federal Open Market Committee have changed their outlook on interest rates in just one short year. In June 2021, the FOMC didn't see interest rates surpassing 1% until 2023, if at all. Now, however, the consensus estimate for 2022 is over 3%, with rates as high as 4.5% estimated for 2023. And I think there's a very important learning point there. We as investors have no control over what monetary policies global central banks decide to implement. Not only that, but what we think might happen in the short term is far from certain, as has been illustrated by the change in Fed interest rate expectations over the course of the last year. And the impact of those policies can be a recession, stagflation, a bear market, a bull market, but the lesson is that provided you have a long-term investment horizon, you have to keep going. It's impossible for us to know what way the market is going to go today, tomorrow, next month, or next year. So having an investment strategy that keeps you consistent during the good times and the bad is the best recipe for success. But let me know, what are your thoughts on the Fed's decision to increase interest rates by 75 basis points? Do you think that's enough, or would you have liked to see a bigger increase? And let me know if your portfolio has been taking a beating lately and whether you're doing anything differently in response. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.